How are you, folks? The Enzo Di Cosenzo podcast, and today we're going to be working on the problems from plan assets. So what we're going to do now is these are going to be shorter videos where we're just going to work on the comprehensive problem 1, comprehensive problem 2, and maybe a little. I mean, I could make it all just one big video, but we're not going to do. We're going to just break it up into pieces. So let's work on this particular problem, which has all 3 methods of depreciation in there. So you're going to use straight line, you're going to use units of activity, you're going to use declining balance, and you're going to apply the depreciation rates to book value, and you're going to make all the computations, all the depreciation expense, the accumulated depreciation, and the final book value. Okay, you're going to do all those. Yeah, it's always good to have a nice highlight of what you're working on. So we have a company here. They purchased an asset for $18,000, and the salvage is expected to be $2,000. It's expected to be $2,000 at the end of the 4-year useful life. Whatever the piece of equipment is, it's going to be 160,000 hours, and then 12, 13, 14, 15. We have a couple years of usage that we can use for the units of activity method. So we're going to create depreciation schedules for the following: straight line, units of activity, okay, and then declining balance. So your initial cost was 18,000. Okay, so under cost, 18,000. Salvage was 2. Useful life, 4 years, and then 160,000. 160,000 hours. Okay, so we listed all of our initial numbers here. Okay, so we'll use straight line first. And the depreciable cost is the cost of the asset minus the salvage value. Okay, it represents the total amount subject to depreciation. Okay, so the cost is going to be equal parenthesis the 18 minus the 2,000, so it's 16. The annual expense is just that divided by 4. And the rate is at 4,000 divided by 16,000, which is 25%. Okay. Okay, so this was just simply the subtraction of these two, 18,000 minus 2,000, divided 16,000 divided by 4, and then the percentage, 4,000 over 16,000. Okay. So it applies a percentage rate to the depreciable cost of the asset, and we illustrate that below. So the cost or the depreciable cost is the 16, and that's the same every time. And the rate is just that 25%. And the expense is simply that 4,000. Okay. So that's hopefully that's all just from a good recollection from our previous our previous exercises doing this. The accumulated is simply the sum, starting with the top piece of this. You anchor in the row. We'll go back to this for a second. Anchor in the column, right, and you can go all the way down with this. Okay. That's your accumulated depreciation. And we always put the formulas here. It's the cost minus the accumulated. So in other words, the initial book. Not the 16, the 18. Like that. Down to your 2,000. So how does this work? This is that 30, or part of the 18,000 minus the first accumulated depreciation, and then minus the second one. And again, what's our number here? 18. So this is minus 4, it's 14, minus another 8 is down to 10. Okay, so that's 12,000 minus the 18. Right, that's how you get that right. So it's 18,000 minus 8,000, 18,000 minus 12,000, 18,000 minus 16,000, which gives you the 2. And the percent depreciated is simply the accumulated divided by, like that. Obviously, you want to get to 100 at the end of all that. Okay, this is simply this. The accumulated over the depreciable cost. Okay, so we did this one. So in other words, we showed you how to get the annual expenses, right? What the depreciable cost was. Okay, all the components of this model. We'll use the next method, which is units of activity. And this would be that 160,000 hours. This is equal. We could just redo this computation. The 18,000 minus the 2,000. And cost per unit is you're just dividing these, which is how you get the 10 cents. For the first year, we had them somewhere 40,000. We have them here. Yeah, we have them here again. So right there. So for the first year, 40,000. And the expense is the product of the 10 cents times that 40,000, which gives you 4,000. And so in here, for units of activity, this is going to be 40,000, 1,000, 5,000. Okay. And there's your 160. Come up here. That's your 160. So we checked all those. Cost per unit is just that 10 cents. And the annual expense is that product. Four, 6, 3,500. Yeah, 4, 6, 3,500. All those. I'm just cleaning up these extra loose decimal places, if you don't mind. Just give me a second to do that. And the accumulated is just, this is the same formula from previous, all right? Parachute that in there and then make the changes. This is going to be AT99. Like that. See, so obviously, so you're going to get to everything. So in other words, you're depreciating the whole cost of 16,000. Okay. See how we did that? So that's just the first expense, then the first and the second, the first, second, and third. Okay. And actually, what you can do here also, just to keep it, you can put the column in. Okay. So see how that looks? So you're locked in the column. Okay. And the book, as we've said a number of times here, salvage, we're looking for cost minus accumulated depreciation. So equals that original cost, 18 minus there we go. Okay. So your book was at 18,000 minus the 4, 18,000 minus 10, right? Minus 13,500, and finally minus 16,000, which gives you the 2,000. Okay. And the last one for today, and like I said, we'll do a shorter version of everything. This is equal to 2 times the straight line rate for declining balance. And the rate was 25%. 50%, which is high. And the book that you started at was your 18,000. And this expense, this initial expense would be what? It'd be half of that. Yeah. So equals product these two. Okay. Now this operates slightly differently here. This is the, or 18 month. We'll get to this check in a second. We'll get to that check in a second. So the book at the beginning of the year is just that 18. The rate is 50% and 50%. All right, here's the expense, which is that 9,000. Okay, and we'll use the same formula from previous. That's just that. So the book, so this is the end of year book, would be equal to what you started with minus the accumulated. Okay, so there's our book there. So right, so we're down to 9. So at the the start of the year is what which this was previously. Okay, so the accumulated depreciation is 13,500. Yeah, actually, this formula should be we'll lock it like that. Gotta be careful. So if you're going to use accumulated depreciation, you have to refer to the original book value. If you go year by year, you take the annual depreciation expense. So you got to know your formulas. Okay, how to manipulate all that. So that's that. And this is percent depreciated. Yeah, this is just the depreciable cost. You still get to the same 2,000. You still get to that same 2,000. And this is the dollar sign right there. And actually, all these are the whole story. 84, 98. And now you can see what happens sort of at the end of all this. You don't get to 100%, you get to 105. So there's a little bit of work that we have to do here. So what we'll do is we'll come here and we'll insert 250 because look at what's left. You want to get to 2000, right? You want to get to 2000. So what you need is because the book here is 2250, right? That's the book is 2250, which is right there. Right, that's 2250. So you want to take 250 off. So instead of using this one, you would say accumulated equals the sum. So what are we going to do with this? Annual was 1000. Yeah, you're 875 over, but with an extra 250. So how much over are you? Yeah, you're 875 over. Right. So instead of that, so what you would do here equals sum. All those, comma, the 250. There it is. There's just 16. So let's go through what happened here. So the first 3 years were okay of depreciation. Last year you're over by about 800 and a little bit. So that really needed to be 250 is what that needed to be, and not 1,125. So that got you to the accumulated depreciation of 16,000, right? Which got you to your 2,000 here, which is what you were after. And now you have 100%. Okay, see how that worked? So and also we checked here. We did a little check with this thing. So we did all the accumulated, and then from the depreciable cost, that gave us that what was left was 250, not 1,125. Okay, and this is adjust for book to equal salvage value exactly. Yeah. Okay. So those are those three. I'm just looking. We went through this pretty well here. So you know what? Let's see how we do with this other one. This is comprehensive problem number 2. So and this is Appendix 10A. Yeah. So let's see with the second. So the first one we knocked this one out. This is all we went through the 3 depreciation methods, and that should be pretty clear. So let's look at this next one. At the time of the disposal, you want to determine the book value of the asset, recognize gains or losses, and remove the book value of the asset from the records by debiting accumulated depreciation and crediting assets for the cost of the asset. Okay. This vehicle was purchased for, again, these are really old prices, 28,000, even past 2012, right? A limousine for, I don't think you haven't seen a limousine for that price for a long time. Straight line method, 4,000 salvage. The fiscal year ends December 31. So scrap with no salvage. But sold for 5,000. So I guess we did a couple versions of this. Okay, so I think there's a couple things that are happening here. What's happening is disposal, determine the book of the asset, recognize gains or losses, remove the book of the asset record. Fine. Okay. So acquisition of 28,000, depreciated 4-year service life, 4,000 salvage. We did that. And this was retired with no salvage on 2016. And then it was sold for 5,000. Other expenses and losses. So 3 for the year. Yeah, let's work out the straight line first. I think this is something from the bottom. I think we need to work at this. So salvage 4,000. Cost was 28. It's 4 years. Oh, okay, so we don't have the hours thing. So in terms of the straight line, we did depreciable cost. And the salvage is 4 for this. So again, this is the same computation that we just worked on. The cost minus the expected salvage. The annual expense is this. And the rate is 6,000 divided by the 24,000. Okay. So depreciable cost is this 24,000. The rate is 25%. This is all the same stuff. The annual depreciation cost is 6,000. And again, we accumulate with the same formula. This would be, we'll lock that, right? We'll lock the column. You added up all your 6,000s. Your book would be this 28 minus the accumulated. All right, and you're up to 4,000 with this. And this is going to be accumulated divided by the depreciable cost until you get to 100. 22. Yeah, we did all that. This was just the same thing that we just worked on. Or you could take the rate times this, a quarter of this is 6,000. That's another way you could do it. Okay. But let's do these journal entries. So yeah, the first one is you're retiring this equipment at a loss is where the first one sort of begins here. So you're doing this for the start of 16. Yeah. So you're right there. That's your 24,000. So this comes from here. Okay, that's at 24,000. The equipment write-off was just what the cost of the equipment is. Somewhere here. That's 28,000. So now you need to look at this and say, okay, well, and we had a problem like this in class where you had a equipment write-off. Again, the equipment is recognized as a debit on the asset side when you're in possession of it. When you write it off, the write-off is on the credit side, so you clean it off your books. Similarly, the accumulated depreciation, which is generally recorded as a credit, you have to record that as a debit. So the difference here is your loss, for better or worse, is at 4,000. Yeah, and I think with this one, we could come down here and add these up and all that stuff. And, we could do all that. Equals sum. Here's your 28. So again, and when? So this is January 1st, 2016. We'll remember that where we were in January 1st, 2016 was right after, right after this point in your schedule. Okay. And this last one here is going to be the expense. This one retired us, right? So this is one version. So this is this one, right? A is here, and then B you sell for 5,000. July 1st, 2015. This is before the end of that year. So what you would do is you would prorate. You would prorate your depreciation is what you would do for half the year. Your last depreciation. So that would be Yeah, I'm looking at how I did it. I did the whole formula again for some reason. I don't know why I did that. But you could also just do it like this. You have the expense right there, right? You could do this because it's half the year. This is equal to 50%. And the accumulated is there. Okay. So that's where that starts. Something like this, a prorated version of this, right? To date, disposal to date. And then it says you're going to sell it for 5,000. So the proceeds, that's 5,000, which is right there. Right? That's 5,000 right there. Yeah, this is only depreciated 50% for the final year. So what you would do is you would take the 14 number and add 3. So that'd be 21. This would be 21. Okay. So this equals this thing plus 18. All right, that's your 21. The equipment is still written off. Still 28,000. So you have 26. So you're left with a $2,000 loss, right? Yeah, 2. So this is going to be a couple different ways. I'm looking here. I guess it looks like I did a lot of math here. The value of the asset at 50% point of the last year is 4,000 plus 3,000, so 7,000. So sale at 5 results in a $2,000 loss. Yeah, fourth. I took that plus another 3 that we didn't appreciate it. So that's where the thinking here is. So 7, and then sold it for 5, which was a $2,000 loss. That's a way to do it. So you could say equals parenthesis. That's a crazy way to do it, but I somehow did it that way. So there's the book plus this other 3 that didn't get accumulated. Minus this 5,000. There's your 2. And this big long string of numbers, you could say equal sum. That's how you get your 28,000. There's a couple ways. Obviously, for this to balance, you need another. You could just say 28,000 minus 26,000. But we did it like this. So we took the book, added back. This isn't that other 3,000 here. This other 3 that's here. This is an add back. So it says 4,000 plus 3,000. That 3,000 is the other half of the depreciation, which gives you 7. and then sold it for, so your book value halfway through is 7,000, and then you sold it for 5,000, hence $2,000 loss. Okay, so we did Skyline, and this last piece here is a small little appendix. It says exchange of plan. Ordinarily, companies record a gain or loss on the exchange of plant assets. The rationale for recognizing gain or loss is that most exchanges have commercial substance, and exchange has commercial substance if the future cash flow change as a result of the exchange. There's a loss treatment, and then we have a gain treatment. Okay. Exchange a set of used truck parts for new semi truck. The used truck has a combined book of 64,000 minus the accumulated 22,000 appreciation, which is 42. So 64,000 minus 20,000 is 42,000. The fair value is 26. And the buyer pays 17 in addition to the used truck parts. So you got to compute all this stuff is what you need to do. So or organize what you're doing here. So what happened? This thing. So the fair value out in the market is 26,000. And also Roland paid 17. And again, anytime you do these valuations, and this is a valuation, is what this is, all the different pieces. So what the fair value is, there's a cash component. So the cost of this is the combination. At 43,000. The cash and then the fair value. Those two added up. The book is 42. And with the fair value of the used truck. So the loss on the disposal, and again, it's all on perspective. Obviously, is you're taking these two and subtracting. Okay, that's your 16,000. So what do we do with this thing? The book was 42. The fair value is 26. Yeah, so the loss would be that 16. And had to journalize, how to show this in the journal. Yeah, so your new on your books, the new equipment is this 43 on your books. That's how you would show that. The accumulated. This is just an entry. Oops. Accumulated on this. Because this doesn't include it. And again, you have to look at who's buying what here. Roland, yeah, for an exchange, Roland Company exchange a set of used truck parts and cash. Have combined book of 42. And a fare of 26. So what they're doing is they're buying a new semi. Okay, so your used assets have a combined book of 42. Right, so you're writing off the 22 and then the 43. The cost, right? The cost of this thing. Because what you're doing is you're paying 17,000 cash and then giving something over that's 26,000 of fair market value, which is the 26. Okay. That's why you have these numbers. That's why it's right. That's why it's the 43. It's 17 plus 26. You're writing off the old accumulated depreciation is what you're doing there. And then you're writing off your old equipment, 64, 1, 2, 3. That's your old equipment. That's getting written off. That's from up here. So these two are write-offs. The 64 and the 22. Those are two write-offs is what those are. The cash that's going out the door is 17. And then you got to net this, you got to net your losses now, or your losses or your gains. Obviously, in this one, these are losses. So equals sum. So for loss, it would be 16. Okay, that's what you're trying to figure out here. Yeah, these can get complicated. Okay, there's no and also it's especially trying to figure out what exactly what's and let's revisit sort of what we're doing here. So again, from the perspective of Roland, they're what are they doing? They're acquiring a new semi is what they're doing. Okay, and this is an exchange. So they use some used assets or used equipment with a book of 42 and cost of 64 and depreciation of 22. Those are coming off Roland's books. So there's old equipment that gets written off at 64. There's old the accumulated depreciation that's associated with that 64 also gets written off. That's right here. So You're using an asset that's worth 26,000 and then 17,000 cash. Okay. That's at 43. This is the 26 plus the 17 is at 43. So that's basically all cash is what that is. Okay. So that's your new piece of equipment. And then 17,000 goes out the door. Okay. You have that one. And then you're netting out the 64 and the 22 right there. There's your 64. So it's these two, 64 and the 22. Okay. Yeah. Right. That's cost minus the cumulative depreciation. And this is the fair value of the used truck from up here. Right. These get complicated, right? So obviously your net in terms of your loss, unfortunately, it's a $16,000 loss on this transaction, which we have right there. Right. We said that right there. All right, it's the same 16,000. It's really what happens in here too. There's your 26. Yeah. So if that's your book and you can only get 26,000 for it, right? Your loss is going to be 16, is all that is. Okay. This is a gain, which this will be the same sort of thing here. So here's Mark Express Delivery. So what are we doing with this thing? This is the next one. So clean. So actually, we got everything done instead of 3 different videos. It looks like we got it all done at once, which is fine. Okay, so we're looking at this, and what are we doing here? Here's express delivery, exchange old delivery equipment plus some cash for new delivery equipment. Again, what are we looking for? These guys, it's a new asset, is what that is. New asset. The old equipment, the book is 40,000 minus 28, and the fair value is 19. So we're going to do all that again. There's some cash that was paid. So the cost of the new delivery equipment is simply the summation of all this. Okay. So again, you gave an asset that had some sort of fair value, and then you came up with some cash. Baseball does this when they trade players, they do stuff like this. And the book here is going to be 40,000. Which is that thing. This is just 19. All right, that's simply just 19. And now you're looking for a gain or a loss. Well, and what you're spending and everything too, of course, right? So if this is fair and the book is 12, obviously you're looking at a $7,000 gain is what you're looking at. All right. All right, because this is going to be the 19 minus the 12,000. You know, the book is 12, but you're getting 17 for it, or 19 for it, rather. And we say up here, yeah, it says the fair value of the old delivery equipment is 19. And again, same story here now. So you're retiring something. It's that 40,000 and the 28. So old depreciation is 28. Going to get rid of that. The old equipment gets written off at 40. Yeah, so we'll start with those two. So that's the write-off for the old equipment, right? Old equipment. Cash exchanged hands here, 3,000. There's your 3,000, which is there. The gain we'll get to in a second. We'll get to the gain. And the new equipment between cash and fair value, this is going to be the 22. And there you go. So obviously you have your gain here. You got to fit this thing in. So this is that's 50,000. So this is 7. Yeah, everybody's 50. Right there. Okay. That's your 7. And recording the exchange, we eliminate the book value of the asset given up and record the cost of the asset acquired, recognize the gain on the disposal. Accounting for exchange plan becomes more complex if the transaction doesn't involve, does not have commercial substance. Okay. So again, this was written off. This was written off. This was gained, right? Because you had $22,000. In other words, that's the asset that came onto your books. Was that, and then also some cash left, some cash paid. Okay, and that's how you got your 7,000 to balance everything. That was obviously a gain, right? Because if the book was 12,000 and the you sold it for 19 or got the fair value of 19 for it, then that's obviously you know, you're recording that gain. Okay. So actually, we got all 3 of these done today. So for the graduate group, your assignment, your final exam is this, and we'll see. Maybe even the undergraduates will venture into this where there's all this Excel and you got to make these models because at some point you got to make some models, right? At some point you got to be able to do that. So okay, there's 16 questions there, so we might hit that. Okay, all right, folks. Thank you. All right, folks. Thank you very much.